Leaving your hard-earned money on a savings account is one of the worst things you can do with your money. With the current high inflation levels and very low interest rates on the banks, on savings accounts, you are losing purchasing power fast. Here are a few tips to get a better return on your money. So start now, right after you hit the like button for the YouTube algorithm and subscribe to the Money Network. High inflation and low interest rates, the worst combination possible for money on your savings account. With an interest rate of 0.11% per year and inflation of over 5%, this means that next year your purchasing power will be reduced by 5%, even though the amount of euros in your bank account remains the same. And let's not talk about inflation levels of 7 or 9%. However, higher inflation will eventually result in higher interest rates when central banks are raising interest rates as we speak. But the interest rates will not catch up with inflation anytime soon. So you need to do something else with your money instead of leaving it on your savings account. Something that obviously has a higher return than your savings account and preferably negates higher inflation. So it ideally creates more purchasing power for you over time. Once you have your emergency fund in place and you have extra money you do not know what to do with, you should look at what the experts are proposing. All investment managers of big financial companies agree that the most popular and the most easy alternative option to a savings account to invest it in the stock market. But of course, as you know, investing in the stock market has an inherent risk. It creates risk, a risk that your investments can temporarily lose value when the stock markets go down. If you are very risk aversive and you get nervous when your investments go down, investing might just not be the solution for you. But investing is a long game and you have to put that in your head. And even though risk is involved in investing in the stock market, the long time horizon you have makes sure that your risk is minimized. Look at this graph that indicates the return of a certain index. As you can see, there are several years the index performs bad and notes a negative return. But on the other years, a positive return can be found. Of course, when we invest, we are investing on the longer term. So it's for your future. It's over decades. So if we were to look at the same graph, but we look at the investment periods of 5 years, the negative periods are less frequent and less negative altogether. The high peaks are also topped off. It's more like an average right now. And if we then translate that same graph into a 15 years investment period, all negative periods have gone. That's the power of averages over time. This leads to one of the most important rules in investing. Time in the market will always outperform timing the market. When you are invested, your portfolio will go up, it will go down. But as history proves, in the long run, you will always end up with a bigger value. When you are waiting to actually time the market, your money stays cash and it is essentially losing value. Trying to time the market is also almost impossible. There is always a reason why you are not investing at a certain point in time. You could be arguing that the markets went up too quickly to invest now, or they are going down even more. When I was working in private banking, I saw so many people lose so much money trying to sell when the market crashed in the hopes of buying back at lower points. There were very few people who actually managed to make money timing the market. And even when they did, they would lose all their profits the next time around. So just negate this reasoning. Just don't try to time the market and just invest as soon as possible to stay as long in the market as possible and ideally invest consistently over time. So that's what you do with your 25,000 euros today. You invest it either all in one go today, or you just invest every single month from now until the future. Good luck on your investment journey, and until next time.